Welcome to this Killick Explains video, and welcome to video 3 in my 4-part series on fund basics. And this one is all about investment trusts. So we did what is a fund in video 1, what is a unit trust was the last one, video 2, investment trusts coming up now, and then I'll finish on exchange traded funds in video 4. So what are the key features of a so-called investment trust? And I say so-called because this is actually a listed company that holds shares in other companies. So these are exchange traded firms that specialize in buying portfolios of shares according to a strategy. All right. So as an investor, you are buying shares, just like buying single company shares, if you like, but in the investment trust. You're getting them on the open market at the London Stock Exchange through a broker, and they're fully tradable all day. So there are no valuation points. This is a share that trades all the way through the normal market hours of the relevant exchange. Now, they can pay income. That's a decision taken by the investment trust directors, if you like, or they may offer you growth, or they may offer you a little bit of both. But one of the key features, which we'll come back to in just a moment, is that the value of the portfolio held by the fund and the net asset value, being the market capitalization of it, can differ, if you like. So you can get what are called premiums and discounts, and I'll come back to those in just a moment. So let's move on to pricing. So I've said the market sets the share price for an investment trust. All right, there may be a bid to offer spread around that price, but here's the thing. The extra kicker you can get from an investment trust that you don't get with unit trust is a thing called a discount to net asset value. How does that happen? Well, it's a function of the fact that just like Tesco or BP, where the market capitalization, that's the number of shares times the current share price, can differ from the tangible and intangible assets of the business, so it is possible for the market to price in either a premium or a discount to the underlying portfolio being run by the investment trust directors. Now, there are many debates about why that happens, but disagreements about the underlying strategy can be one of them, and the market can price that in. What that does create is potentially the opportunity to buy into an investment trust at a discount, and should the discount close, you get that plus any performance delivered by the directors. Now, pricing is continuous, as I mentioned, so you can buy and sell on several exchanges potentially all the way through the day. So what about costs? And as an investor, you should consider costs, weigh up performance versus costs. Well, there's stamp duty to pay because these are shares, okay? There are bid to offer spreads, as I mentioned earlier. There can be a gap, quite often is, and it will widen depending on what's happening in the market and liquidity conditions. It will widen and narrow. So that's the gap between the price you pay for shares and the price you can sell them at. There are commissions to deal with and other costs, like platform costs, for example, associated with holding the underlying investment trust. Okay. Now, what are the challenges with investment trust companies? And arguably, why aren't more people holding them? Well, one of them is that they can't advertise in the same way that unit trusts can. So you don't tend to see as much marketing on investment trust companies, but that is in some ways a good thing if you're a fan of these beasts. So what are the challenges? Are they as well understood as unit trusts? I'd argue they should be, but perhaps because they're less well known, they're not. You can get volatility in the underlying share price because there isn't a valuation exercise as there is with the unit trust that links the NAV to the unit price. These things can be volatile. Discounts and premiums can result as the share price swings around, and discounts, although they do sometimes close, can persist, and that can make some investors nervous. Now, I want to mention one twist at the end and finish up with some further information, and that is an arbitrage opportunity. Now, arbitrage is a flash way of saying how to make a bit of money from a pricing discrepancy in the market, and here's one. Sometimes you'll find a unit trust with a particular strategy and almost the same strategy at an investment trust. They may even be part of the same investment house. If the investment trust is cheaper, that is to say its shares are trading at a discount, some people would say there's an argument for buying the strategy a little bit cheaper and hoping that the discount will close. So sometimes you get people switching from one vehicle to another to take advantage of those arbitrage opportunities. Now, I'm going to finish there. If you'd like to know more, then do access my comprehensive video library, killick.com/learn. If you want to read a little bit more about fund investing and investing in general, then there are some guides here, and one of them has a light blue cover. That's editor@killick.com as an email. And to read all about both investment trusts and unit trusts, there are usually articles on both in a slightly more commercial context. Then there's a magazine sitting next to me called Confidant, which I edit. And again, that's editor@killick.com.